Substance refers to the economic reality behind the legal form of a corporate entity. Tax authorities and international organizations, such as the OEC, emphasize substance as a tool to counteract base erosion and profit shifting, BEPS. The presence of substance indicates that an entity is not merely a shell company, but is engaged in genuine economic activities that align with its declared purpose. Key elements of substance typically include 1. Physical presence, office space, equipment, and facilities in the jurisdiction. 2. Personnel, local employees who perform essential functions. 3. Decision-making, board meetings and strategic decision-making processes occurring within the jurisdiction. 4th, commercial rationale, evidence that the entity's activities align with a valid business purpose beyond tax benefits. Substance refers to the economic reality behind the legal form of a corporate entity. Tax authorities and international organizations, such as the OEC, emphasize substance as a tool to counteract base erosion and profit shifting, BEPS. The presence of substance indicates that an entity is not merely a shell company, but is engaged in genuine economic activities that align with its declared purpose. Key elements of substance typically include 1. Physical presence, office space, equipment, and facilities in the jurisdiction. 2. Personnel, local employees who perform essential functions. 3. Decision-making, board meetings and strategic decision-making processes occurring within the jurisdiction. 4th, commercial rationale, evidence that the entity's activities align with a valid business purpose beyond tax benefits. Significant people functions are central to demonstrating substance. Introduced in the context of transfer pricing by the OECD's BEPS action plans, SPFs refer to the key decision-making and operational activities that contribute to the assumption of risks and the generation of profits within a business. Defining SPFs encompass the activities that control or manage key risks, e.g., credit, market, or operational risks. Influence decisions related to the development, enhancement, maintenance, protection, and exploitation (DEMP) of intangible assets. Drive the allocation of profits within an MNE group. For example, in the case of an intellectual property (IP) holding company, SPFs may include research and development, R&D management, strategic IP decisions, and royalty contract negotiations. For a finance company, SPFs could involve managing credit risk, determining lending policies, and overseeing funding strategies. The alignment of SPFs with substance is critical. A mismatch, such as an entity claiming significant income in a low-tax jurisdiction without hosting SPFs, can lead to tax recharacterization, profit reallocation, or denial of treaty benefits. Key considerations for SPFs and substance. 1. Location of decision-making. SPFs must be performed in the jurisdiction where the income is attributed. Virtual decision-making from other locations undermines substance claims. 2. Qualified personnel. Employees performing SPFs should have the expertise to justify the associated risks and returns. 3. Supporting documentation. Clear records of decisions, actions, and policies related to SPFs are essential to withstand audits. 4th, integration with operational activities. SPFs should align with the broader economic activities of the entity, ensuring coherence with its business model. 1. Regulatory divergence. Different jurisdictions impose varying substance requirements, creating challenges for businesses with operations across multiple countries. For example, while the EU's Anti-Tax Avoidance Directive 3, ATAD 3, introduces strict substance tests for shell entities, Other jurisdictions may have less stringent rules. 2. Remote work and global mobility. The rise of remote work and flexible employment models complicates the location of SPFs. Employees working from multiple jurisdictions may inadvertently create tax risks by diluting substance in the declared jurisdiction. Third, evolving standards for SPFs. The OECD's emphasis on SPFs continues to evolve, particularly in the context of the digital economy and the taxation of intangibles. Businesses must adapt to changing interpretations of SPFs to remain compliant. Fourth, audit and litigation risks. Tax authorities increasingly challenge the substance of entities that lack robust SPFs. Audits often focus on the mismatch between income allocation and economic activity, leading to costly disputes and potential reputational damage. To mitigate risks and ensure compliance, businesses should adopt a proactive approach to managing substance and SPFs. 1. Conduct a substance audit. Periodically review the entity's operational setup, ensuring alignment between income, SPFs, and decision-making activities. Address any gaps in physical presence, personnel, or documentation. 2. Train personnel. Invest in training employees who perform SPFs, ensuring they understand their roles and responsibilities. Highlight the importance of aligning their activities with the entity's declared risks and returns. Third, localized decision-making. Ensure that board meetings and key strategic decisions are conducted in the jurisdiction where the entity claims substance. Maintain detailed minutes and records of these meetings. Fourth, monitor remote work risks. Implement policies to manage the tax implications of remote work, particularly for employees involved in SPFs. Consider centralized locations for key personnel to reinforce substance claims. 5. Leverage technology-used tools to track decision-making processes, monitor risk management activities, and document DEMPI functions. Such tools can help demonstrate the alignment of SPFs with substance during audits. Substance and significant people functions are cornerstone principles in modern international tax compliance. Businesses must ensure that their operations reflect genuine economic activities and align with evolving regulatory standards. By strengthening substance, aligning SPFs with declared risks and returns, and proactively managing compliance risks, MNEs can safeguard their structures against audits and litigation while optimizing their tax positions. Amid the growing scrutiny from tax authorities and the international community, achieving robust substance is not just a regulatory obligation, but a strategic imperative for long-term success.